Fed is coming after stocks and real estate in order to contain rising inflation. The S&P entered bear market territory. The yield curve inverted for the first time since April, signaling a recession. Bitcoin tanked below 24K. There's now a 21% probability of a 75 basis point rate hike on Wednesday, opposed to a 50 percentage point hike originally priced into the market. Hello, ladies and gentlemen. I hope you're all doing well. Welcome to the channel. Today we're going to cover breaking news from Yahoo Finance, Fortune, and Len Kiefer, Chief Economist for Freddie Mac, and much more. There's so much information to unpack here. Thank you so much for tuning in. One caveat, I'm a Florida, Georgia real estate broker, not a financial advisor. All right, let's begin. Mortgage rates rose above 6% as the 10-year Treasury bond rose above 3.32%. Housing is expected to correct 15 to 20% during a recession for more than 14 markets, and 40 markets are endangered of a price correction. Freddie Mac Chief Economist said we're in the beginning stages of the most significant contraction in activity since 2006. The Fed is pushing down asset prices with higher interest rates and quantitative tightening, creating a reverse wealth effect in order to fight inflation, and the data suggests they're doing just that. U.S. bond market flashes recession warning as yield curve inverts. A closely watched part of the U.S. yield curve inverted Monday as investors dumped short-term debt on concerns that aggressive rate hikes will lead to an economic slowdown. The U.S. 2-year yield exceeded the 10-year for the first time since April. Short-term yields that are higher than long-term yields are abnormal and are historically seen as heralding a potential recession. Concern has been mounting that surging inflation will require more rapid Federal Reserve policy tightening, which in turn will reduce consumer spending and business activity. U.S. inflation data on Friday rose to a fresh 4-decade high, surprising economists. Okay, so the 2-year and the 10-year bond briefly inverted after heading close to inversion in the last few days. This is generally an indication that the economy is heading into a recession. In addition, the 3-year, 5-year, and the 7-year Treasury bond have also inverted. Soaring Inflation Fuels bets on sharper Fed rate hikes. Stubbornly hot U.S. inflation is fueling bets that the Federal Reserve will get more aggressive about trying to cool price pressures and even potentially ditch its own forward guidance by delivering a jumbo-sized interest rate hike in coming months. Fed policymakers had already all but promised half-point interest rate hikes at their meeting next week and again in late July, following May's half-point hike and the start of the balance sheet reduction this month. That would be more policy tightening in the space of 3 months than the Fed did in all of 2018. Prices of the Fed's funds futures contracts now reflect better than even odds of a 75 basis point rate hike by July, with a 1 in 4 chance of that occurring next week, up from 1 in 20 before the inflation report, and a policy rate in at least the 3.25% to 3.5% range at year end. Okay, so there's now a 21% probability of a 75 basis point rate hike on Wednesday, opposed to a 50 percentage point hike originally priced into the market. It is, however, more than likely we'll see a 50 percentage point rate hike this coming Wednesday. Mortgage rates reached 6.13% for the best borrower as the 10-year Treasury bond rose above 3.32 percentage points. Consequently, this will make a home mortgage unaffordable for the average borrower, creating severe demand destruction for housing. These 40 overvalued housing markets could see 15% to 20% home price declines if a recession hits. While Mark Zandi doesn't predict national home price declines, he estimates significantly overvalued housing markets, places like Boise and Charlotte, could see 5% to 10% home price declines over the next 12 months. If a recession actually materializes, something Moody's Analytics gives a 1 in 2 chance of occurring over the next 24 months, then Zandi says national home prices could fall by around 5%. Meanwhile, if a recession hits, Zandi says those significantly overvalued housing markets would likely see home prices slashed by 15 to 20%. And it goes on to say, among the 413 regional housing markets measured by Moody's Analytics, the firms deemed 96% are overvalued. Simply put, nearly the entire country has house prices that are higher than underlying fundamentals would historically support. Among the markets analyzed by Moody's Analytics, 183 are overvalued by more than 25%. That's up from 150 regional housing markets it deemed overvalued by more than 25% in the fourth quarter of 2021. The most overvalued markets are concentrated in fast-growing cities in the Mountain West and Sun Belt that benefited from the nation's work-from-home boom. That includes both Boise, overvalued by 72%, and Charlotte, overvalued by 66%. Among those overvalued housing markets, which ones are actually likely to see home prices fall? In order, Zandi points to these juiced-up regional housing markets: Boise, Idaho; Colorado Springs, Colorado; Las Vegas, Nevada; Coeur d'Alene, Idaho; Tampa, Florida; Atlanta, Georgia; Fort Collins, Colorado; Sherman, Texas; Jacksonville, Florida; Idaho Falls, Idaho; Lakeland, Florida; Greeley, Colorado; Longview, Washington, Charleston, South Carolina, Albany, New York, Denver, Colorado, Clarksville, Tennessee, Greensboro, North Carolina, and Charlotte. If you live and work in one of these markets and you're not planning to stay in your home or hold on to those rental properties, you may risk missing an opportunity to capitalize on a historically high asking price, thereby waiting out a 10 to 15-year market cycle. Although you'll have to decide what works best for your financial goals and personal situation. Len Kiefer, chief economist for Freddie Mac, posted to Twitter, "The U.S. housing market is at the beginning stages of the most significant contraction in activity since 2006. It hasn't shown up in many data series yet, but mortgage applications are pointing to a large decline over summer. Purchase applications down 40% from seasonally adjusted peak during COVID in spring of 2020. Applications also fell 40%, but came roaring back in short order." And it goes on to say, such a rebound is unlikely in the current environment, but neither is the very, very slow recovery we saw in 2011. After hitting almost 500,000 average, conventional purchase mortgage loan sizes are moderating. Though even if loan size is down about 8% from peak, it's still up more than 25% from where it was at the beginning of 2020. Higher loan sizes coupled with a surge in mortgage rates have obliterated affordability. Taking average loan size and average interest rate, the implied monthly payment is up over 35% from a year ago, plus $670 per month in P&I payments. Do you think we're in the wake of a housing crash? Let us know in the comments. Okay, so today's takeaway. The yield curve inverted for the first time since April, signaling a recession. There's now a 21% probability of a 75 basis point rate hike on Wednesday, opposed to a 50 percentage point hike originally priced into the market. Mortgage rates reached 6.13% for the best borrower as the 10-year Treasury bond rose above 3.32 percentage points. This will make a home mortgage unaffordable for the average borrower, creating severe demand destruction for housing. Moreover, housing is expected to correct 15 to 20% during a recession for more than 14 markets, while 40 markets are endangered of price correction. And finally, Freddie Mac Chief Economist said we're in the beginning stages of the most significant contraction in activity since 2006. If you like this video, please consider subscribing to the channel and hit that like button. I'm a Florida, Georgia real estate broker, not a financial advisor. Thanks again. We'll see you in the next video.